let's not forget that the economic impact of this virus is going to be a lot greater than when we had SARS, because of the fact that consumption in China right now is basically about 70% of the economy, and China today, compared to 2003, is the world's second biggest economy.
Right.
So if the Chinese economy slows down more than expected, then of course that's going to have a bigger negative impact on the global economy. And because it's now 70% of the economy, and everybody's staying at home, being locked down, then consumption will definitely be affected to a higher degree than during the SARS period.
Okay, that's an excellent point. If we look at just the contribution that the consumer now makes to the Chinese economy, but what about to the global economy? Because the question that seems to be on investors' minds is whether or not this can be contained to a short-term negative economic impact for the domestic economy, or whether we're going to see global implications given this late-stage cycle we're in.
Well, if you look at Asia itself, Chinese tourism is now a bigger part of the economy for almost all countries regardless, right? So some of that demand could perhaps actually come back in the future when everything's settled, the virus is contained, and then people start traveling again. But some of the consumption on a short-term basis is gone forever. Like for example, Chinese New Year, 2 weeks of consumption, right? That's probably gone, not going to come back. So again, I would think that the impact is probably a lot bigger on a short-term basis. But again, we don't expect this to actually be a prolonged, sustained kind of thing, because I think if you compare it to all the other periods where we had viruses, right, the markets come off on a short-term basis, but there has never been a sustained, prolonged, dramatic collapse where the markets are concerned.
Mandy?
In which case, Kelvin, would you say that this is a buying opportunity in this big drop in Chinese stocks today?
Yeah. I mean, I wouldn't put all my money in right now, because I think to a certain extent, you're still trying to catch a falling knife. But let's say if I have $100, I'll probably put like $25 to $30 in there, and then I'll slowly average in over the next 3 months. I think that's a better strategy to do it than actually to go in full scale at this point in time.
And as you sort of, gradually buy in over that period, Kelvin, what exactly are you waiting to buy?
Well, I think some of the tech stocks still look pretty good. We like the Chinese internet sector. We do think that the valuations there are still pretty reasonable, given the fact that the growth is actually very, very high. And on top of that, these companies also tend to benefit, given the fact that now in some of the Chinese cities, you have 5G networks already up and running. And that means that you don't actually have to be face-to-face. You can do a lot of telecommunicating, you can do a lot of telemedicine, etc., etc. So that will actually come in very, very useful for some of the regions that have actually been affected by that, and that's why we actually like this sector, and this is an added reason to actually buy into the sector.
What would you happily leave aside? What wouldn't you touch then?
Well, the usual stocks on the Chinese on the Asias and on the HSCEI as well, like for example the Tencents, the Alibabas, etc. I mean, these are the stocks that we actually like on a longer term basis.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.